Hey guys, it's Sasha. If you are an investor, you've probably heard a thing or two about dividend investing. It seems that almost every finance YouTube channel out there is telling you how amazing dividend investing is. Popular finance blogs are waxing lyrical about dividend investing, and finance influencers all over on Instagram, TikTok are showing you their dividends rolling in. And they are telling you that you need a dividend investing portfolio. The problem is that dividend investing sucks. There, I said it. And I am in this video going to explain what the big problem with dividend investing is, and hopefully I'm going to go a little deeper on explaining this and the analysis than what I've seen other people cover, people who advise you to, stock up on dividend stocks. First off, let's talk about what being a shareholder means, because understanding this is really crucial, and I actually think a lot of people who strongly advocate pure dividend investing at the moment don't necessarily understand this bit. Being a shareholder in a business means that you own a part of the company. And if you own a few shares in a huge public company, that means you own a very tiny proportion of that whole company, but you still do own that little chunk. And being a joint part owner of the business gives you two major financial ownership rights. The first is the shared right to the company's current asset pool. You are a joint owner of the company's current assets. If the business, for whatever random weird reason tomorrow, decided to stop trading or entered liquidation or something else, then you, along with all the other shareholders of that company, get to split the cash sitting in the bank and all the other assets between you after debts are settled and according to whatever rules. But as a shareholder, you also own a part of the future cash flows of the business coming in. So you own the rights to money the company will earn in the future, as well as the money that they already have. And in a very simplified way, when the company goes and earns that money in the future, it will be added to the company's assets. So at that point, the total amount of assets will increase, and so your share of that total will increase too. And that's why when we value companies, we place a value on the current assets that have some kind of near liquid value, and we also forecast the future cash flows and we add those to the total. Notice how dividends are not part of this calculation. They are somewhat irrelevant in the setup, and this is why. When the company earns money and it's added to the company's bank account, if you will, you already own that money as a shareholder. If the company chooses to pay a dividend, you do not actually gain anything as an investor. Just let that sink in. The dividend that you receive does not give you anything that you don't already own. What happens is this: the company takes the profit that is already sitting in the bank account that you already own, and it simply just pays you out a part of that profit in cash. So money is moving from one place to another, but the total sum doesn't change. So now the value of the bank account that the company has drops by the exact same amount that they've just paid out. So you own the same amount of money in total, and this is why the concept of ex-dividend share prices exists. If you own stocks that pay dividends, you'll notice that the share price will drop every time a dividend is paid out to reflect the fact that the money has been taken out of the bank account from the company and placed into your bank account, if you will, instead. So I think it's really important to understand that the day you get paid a dividend, nothing has actually changed in terms of your overall financial ownership of assets perspective, except that some of the value that you used to have in the share price has essentially been converted for you into cash. But as a dividend investor, the theory is that you go and reinvest that money right back into the company, right? That's what people tell you need to do, because then you are reinvesting the dividends and then it all grows and accumulates. So the net effect for you as a shareholder is, if you do that, is that you will now own a slightly larger number of shares that are worth less each than if the dividend was never paid in the first place. But in theoretical principle, the total value of that shareholding in dollars or pounds is the same, whether the company is paying dividends that you reinvest or not. Investing in dividend stocks simply scratches an itch. You get to see the actual money. You get to see physical amounts entering your account. You get a little statement notification saying that a few dollars have been deposited into your account. And it triggers those parts of our brain that like receiving rewards, the same parts that like collecting pointless tokens in games on our mobile phones or gambling. But here is where the problems with dividend investing really start. In company valuations, the value of future cash flows is almost always a much bigger component of the share price than the value of current assets. And the share price goes up if the expected value of those future cash flows goes up. And in order for the value of future cash flows of a company to go up, the company needs to be able to grow. It needs to be able to make more profit, which means generating more revenue and making higher margins potentially on that revenue. And in order to generate more revenue and maybe also get higher margins, the company has to build more factories. It has to invest in more research and development. It has to invest in its infrastructure. It has to hire more staff. It has to hire more qualified staff that will therefore be more expensive staff. The company has to spend money on marketing, on higher operating costs. The company needs to spend money to grow. That's the general principle. And if the company that you are investing in is paying money out into dividends, then guess what? It will not have as much money to spend to pay for future growth. And that is a sign that a company is running out of ideas on how it can spend its cash. It is a sign of stagnation. And I'm by no means saying that this is a universal absolute truth. It's not true to say that every company that pays any form of dividends or maybe the share buybacks is uninvestable. Completely not what I'm saying. I invest in some companies that do pay dividends. I just don't invest in companies because they pay dividends. And when you look at dividend stocks that pay particularly high levels of dividends, you can actually begin seeing a pattern. Here are some of the really big dividend paying companies around. Altria Group, they sell cigarettes. Philip Morris, they also sell cigarettes. Oniok, they sell fossil fuels. Chevron sell fossil fuels. Oh, here's another one. Imperial Brands, they sell cigarettes. And sure, this might be cherry picking, but I literally picked the top ones from some of the popular Google search results for high dividend stocks. But there are other companies in other industries like insurance or companies that buy distressed debt. Sure, there's a whole load of other companies. But if you take the rose-tinted dividend investor spectacles off, high dividend yields are very often a very bad sign for the future prospects of a company. Typically, companies that are paying very high dividends are doing it because they have to. They are typically companies that are in industries that are dying out or going away. Companies in industries that are on the up and are growing like crazy will usually not be paying 8% dividend yields. It's almost like a bribe by that company to get someone to invest in them to prevent the share price from tanking sooner than it perhaps otherwise would. And the problem is that the share price graph of high dividend companies does not look pretty. Vodafone is a very popular dividend stock in the UK, trading at £1.10, which is lower than its price back in 1997, but it doesn't stop a whole load of people on YouTube telling you that you really absolutely need to have some shares in your portfolio. If you're in the US, don't worry. You don't have to invest in UK stocks because you have AT&T, your own exact version, and they pay an incredible dividend as well, and their share price, well, it's also, for some reason, worth less than it was in 1997. But that's okay. You're getting almost an 8% dividend yield, except when you add the dividend yield and the share price growth together and look at the total performance of the stock, then those dividend stocks either underperform the market quite considerably or, in the best case, roughly match the market. Because remember, the dividend stocks do not pay high dividends during periods of high growth. In fact, those dividend yields are considerably lower. So it's not the case that you have to add the maximum dividend yield over that whole period to the growth. It will actually come out a lot lower. And some dividend investors will tell you that dividend stocks outperform non-dividend paying stocks, which is actually incidentally true. Unfortunately, that completely pointless data point doesn't prove what those people think it proves. Companies don't pay dividends for two main reasons. They either choose to not pay dividends because they have better things to do with cash, like, reinvesting it back in the business to help fuel company growth, or the company is not making a profit or making very low profits. And dividends can only be paid if the company is profitable. So yeah, companies that pay dividends happen to do better than companies that are losing money. That is true. But the fact remains that real robust growth stocks can and do outperform dividend stocks over time. I can get a 9% return on my money by investing in a total market ETF and not worry about anything, not have to do any picking, just put my money every month and forget about it. If I decide to pick my stocks, and I'm one of the very few people who do happen to beat the market by picking the right ones, which most people will not, I might be able to get 15 or 20% return on my money. But as a dividend investor, it is pretty much impossible to get double-digit returns, so you're signing up to match the market return in the best possible scenario. And for me, the truth is that the technology has pretty much killed the point of dividend investing, but people haven't realized it yet, because we're still following the same approaches and the same ways of thinking that were developed when this wasn't the case. Shares in companies are much more accessible and are much more liquid than they ever were in the past because of our retail investor ability to access the market. Companies can grow in value considerably faster than they were able to in the past because of those advances in technology. And the combination of these factors means that the proportion of market returns that is made up of dividends has shrunk from being 40 to 50% of the total stock market return for a long period, and definitely at least from the 1940s to the 1970s as per data that people have collated, to being less than 20% of the total returns now. And I personally don't think that that trend is going to change. In fact, I think it will continue, and the return from dividend stocks will continue to fall over time. But who knows? I may well be completely wrong, and I might be getting completely the wrong end of the stick, and I'm sure a lot of people will disagree with me, but we'll have to wait for time to prove which way this one is going to go. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really, really appreciate it, and as always, I'll see you guys later.